where do you stand as a venture capitalist whose portfolio companies use Silicon Valley Bank?
Yeah, I think thanks for having me. I think what's important about understanding the people that are going to be the most affected here are early and mid-stage companies, more so than late-stage companies. By the time you get to a certain stage of revenue and balance sheet, you start thinking about diversifying your risk and the types of partners that you have around the table. So Morgan Stanley, JP Morgan, Citibank, et cetera, the whole list of the larger banks. I think the thing that's really important that people have been forgetting is that our job in our ecosystem, so as an investor, as a fiduciary of capital, as a fiduciary sitting on the boards of these companies, is to make sure that we're giving them the best advice, and we make sure that we can help them think about what they need to do. And for a large set of us, not just me, we started giving this advice a couple of weeks ago, probably more so when we got louder over the last week, and then obviously over the last 24 to 48 hours. But it's really just about diversifying your risk, where your cash is sitting, and then how you're sweeping that cash. Is it in treasuries? Depending on how much deposits you have in the first place. The second piece I think a lot of people forget is that a lot of these companies do rely on banks. And Silicon Valley Bank was a pillar of the community that helped support a lot of the underwriting the risk of the assets in order to get them venture debt. They worked with a lot of venture funds, but they were a lender. They were also a lender for capital call lines of credit for funds. Funds banked with them, not just our management companies, but the funds themselves.
Yes.
So this actually reverberates pretty quickly in the ecosystem around what it's going to look like for not just the companies, but their backers.
Does your fund bank with them?
We do not bank with SVB. We bank with a larger set of providers that are out there, and then our capital call lines of credit are with different service providers as well.
And Arjun, just again, let's start with the issues for the portfolio companies. If they want to make payroll, for example, you're giving them advice. At what point do you and other VC backers need to give lines of credit, give money without the strings attached to those founders, those companies, if they can't access it from their own banks at the moment?
Yeah, it's a good question. I mean, I think there's some venture capitalists that might not be they might not have the capability to fund. It's not as easy as just sending the check. I saw some tweets from some angel investors, in my opinion, that are sort of ill-educated on the process. You can't just wire money to help the company, right? There's a process that you go through. You have to do your fiduciary and understanding the risk of where the company is, and if if the company itself is underwritable in the first place. So again, early stage and mid stage, this is more of an issue. Late stage, it's less of an issue. But for some of these companies that don't have the ability to access payroll, I think a lot of what we're trying to do is who can we set them up with that has the capability to underwrite them? What can we do in the short term? Do we do bridge loans? Do we write more investment into the company through equity? I think one of the issues is that you're going to have a lot of predatory folks out there going after some of these companies if they can't meet some of these liabilities. And our goal, again, as fiduciaries, is to make sure that doesn't happen.
What's interesting, of course, Ed, is you've been writing throughout the day. Who then, hate to say the silver linings in these clouds, but who benefits? Where does the money flow ultimately from portfolio companies that are trying to diversify at this moment, and indeed the VCs too?
Well, there are many venture capitalists that believe actually staying put was the right move, but the name that I kept hearing time and time again was JP Morgan, that was getting a lot of phone calls, but also some lesser known banks. Mercury is an example. Some VCs saying, get a bit of your capital in bigger banks, but go with some of the startups too because of the benefits they're offering. What was really interesting as well is this is kind of laying bare the situation right now for being a startup, being a founder, right, Arjun? You've been writing about the desert that we are traveling through in the world of VC and startups. There is a deficit of available capital. And my question to you is, how much worse is that now, given the events of the past 24 hours?
Yeah, so there's two pieces here. Over the last 5 years, I think the way to think about it is the Fed first printed trillions of dollars. Then they denied anything was happening. Then they said it was transitory. Then we put their rates to the moon. So what happens is there's a lot of trickle effects that come from this. So the first is that a lot of venture capital went into a lot of these companies, may they be good or bad. So roughly about $1.5 trillion over the last 4 to 5 years. Those companies, in order for them to meet their demands or growth concerns, they probably need another 3 to 4 trillion of capital. Where is that going to come from? This was before SVB. And so that becomes an issue. Now, all of a sudden you have SVB, people generally get scared. It may not be logical, and there might be capital around the table, but they just get scared and they're deer in the headlights. So I think what you're going to see is flight to safety. What are the assets that you go after? How do you continue to bankroll them? How do you do concentration of your time and capital into these companies? And which ones are going to be resilient? And so, I think this probably takes about 3 to 6 months to go through the system. I do think it gets worse over the next 12 to 16 months, just because a lot more companies will need access to that capital. And I think the one thing that people really forget here is that these companies need this capital in order to grow, or in order to hit their certain thresholds of their unit economics, because most of them still haven't been able to shed enough people, still haven't been able to get into a place that's healthy. And the capital needs are going to become greater and greater over the next year.